Welcome back, ladies and gentlemen. My name is Arya. I don't waste your time, so let's get straight into it. Today's video, I got the most incredible AI stock for you guys. I have a company that's up over 500%, has to do with AI, incredible company, and of course, I'm talking about Crocs. Crocs, yes, the shoe company. And of course, if you haven't caught on, I'm obviously joking here. Crocs is not the hottest new AI company. It's a shoe company. They make very comfortable shoes. And yet the stock has massively outperformed many big tech companies such as Google and I believe Amazon. All these different companies, it's outperformed that, definitely Apple, right? But yet it's such a simple brick and mortar business model where they sell comfortable shoes. So in today's video, we're going to talk about the past 5 years of this company's absolute financial clinic that they've put up and whether or not that could continue. It's a company that heavily relies on their brand. So we're going to definitely do an analysis on that and why I actually think that the brand is quite unique in the sense that they actually own intellectual property of the specific plastic that they use. But we'll dive into that later. Just to get a start going, I just want to establish that this is in fact this Crocs that we're talking about. Yeah, they make these shoes. They do have this other brand called Hey Dudes that is also, yeah, I believe these ones right here. Similar to these ones right here. That's the actual Crocs ones. But anyways, they have like comfortable loafer type shoes that are like similar looking to this one. But yeah, as you can see, this is literally the business model. They just sell these cool looking, oftentimes colorful shoes that are incredibly popular, especially with teenagers and young adults and all that type of stuff. And yet the stock has done absolutely fantastic. And to kind of start this off, of course, like many of you guys understand that, like, for example, if you're looking into big tech companies and that type of stuff, they have very good fundamentals. But I really do want to dive into the fundamentals of Crocs, just to kind of set the stage here, right? So looking at margins, of course, margins are very important. Gross margins, right? 56%. What that means is that Crocs can manufacture their plastic shoes for $44 on average and sell it for $100. Right? Again, just taking averages here, right? That's incredible. That's up there with Google. I think Google's in the same ballpark, roughly 55, maybe 60% gross margins. Same thing with ASML. ASML, they make massive lithography, technology, big machines, and they sell them and they ship them off to TSMC. And they have the same gross margins as this tiny little shoe company with a market cap less than $10 billion. Anyways, moving on here, we got operating margins, 26%. Again, might I remind you, as of last quarter, just before last quarter, Google, the search business, scale economies, capital light, that business had the same exact operating margins as this little shoe company, right? Absolutely incredible. And one thing, just on the gross margin side of things, the average of the S&P is about 35% gross margins. So Crocs happily sitting at 56%. Seems like they got a very valuable brand with perhaps a lot of pricing power. Again, we'll dive into that as we go on with the video here. Net and free cash flow margins roughly in line, right? So the reason this is important is to note that net income, almost all of it translates to free cash flow. This will come important when we dive a little bit deeper into the video, especially with the debt side of things and all that type of stuff, whether they're going to be able to pay that back, growing dividend, perhaps buybacks, all that type of good stuff. Yeah, so they are a little bit heavier on the debt side of things, roughly $2 billion in debt, but operating income is just over $1 billion, so they should be able to chunk that down with the coming years. And then, of course, our capital efficiency metrics here, ROCE and ROIC, roughly about 35-40% on that front. So you might have noticed they got pretty good fundamentals, right? You could go out and buy as many shares as you possibly want for a measly 11 trailing PE. I'm going to say that one more time. You could buy shares of this company for essentially a commodity multiple. This company, if you didn't know, a commodity multiple, which is a multiple below 12, according to Michael Mauboussin, a commodity multiple means the company is priced in for value destruction, right? So on a going forward basis, they're expected to destroy value. I think the capital efficiency metrics here would lead you to believe otherwise. So yeah, absolutely bargain pricing, and this will play a little bit into the thesis later on with them doing incredible amounts of buybacks as they pay down that debt. So moving on, I wanted to go a little bit off script here, just kind of raw reactions. I briefly skimmed through the presentation, but I don't know, I just want to go through the presentation with you guys, at what stage the company's at. They reported May 7th of very recently, about 5 days ago. So just some quick things. I just mentioned that commodity multiple, right? So they're priced in for like negative growth. I think the revenues would lead you to believe otherwise. Revenues up 7%. The Crocs brand itself growing up about 16%. International revenues. So I'm going to talk about competition and what could possibly kill the company later on. but international revenues being up 24%, that's absolutely massive. DTC stands for direct to consumer. WHL, I believe that's through wholesale. So their wholesale channels, like for example, they sell in what's that shoe company? Foot Locker and Champs and all that type of stuff. Like that would be the wholesale part of the business. DTC is direct to consumer, so on their own website or their own stores. They actually have their own stores, right? Hey Dude brand, it seems Hey Dude brand is the segment of the business which is kind of dragging the business down. That actually had negative growth year over year, so declined about 17%. I'm not particularly happy about that. A little bit of a red flag, but I don't know what the revenue splits are. So I think it seems, roughly about maybe 25% of revenues is derived from the Hey Dude brand. So it is a smaller revenue. Oh, they actually break it out for us here. Beautiful. 23% to Crocs is 77%. So it is a very meaningful part of the business, but I don't know. I'm not particularly happy with that. Adjusted operating margin of 27%. So yeah, as you just saw, they have very, very high operating margins, right? So the S&P average might be around 10% operating margins. They're coming in at roughly triple that, right? Absolutely incredible. 50-50 split on wholesale channels versus direct to consumer. International makes up about 40% of the business, while North America's in the 60% range. Here, driving durable and consistent growth, tier 1 market share gains. Yeah, so of course they are the number one player in this category with the like the plastic shoes and that type of stuff. And the reason for that would largely have to do with the fact that they actually own the intellectual property to the specific chemical that is used to make these plastic shoes, right? So they quite literally own the IP to the actual chemical that's used to make these shoes. And if you go to, I'm personally, of course, I love the brand. I have their shoes and all that type of stuff. But if you ever buy one or wear one in Walmart or anything like that, any of the copycats, you would immediately notice quality differences. It's a cheaper plastic. It doesn't quite feel the same. It's not as comfortable. So that's kind of speaks to the moat of the business, right? Like they have the IP for this plastic and it's irreplaceable, and they're able to charge a premium just because of that, right? Walmart might come in at $20-$30. Crocs over here, you're spending $50-$60. Go upwards, especially if you get these little tags. I don't know if you see these. You could put these little pins inside it, make it customizable. They also make a note here, number 7 footwear brand in Piper Sandler. Piper Sandler is a research firm, I believe. They do like a semi-annual little survey with teens and all that type of stuff to see where their brands rank. So they've been a top 10 brand for 4 years straight. Makes sense. Around 2020, because of TikTok and all that type of stuff, they gained massive amounts of popularity. Again, makes sense. 16% revenue increase year over year, exceeding high end. Yeah, there you go. So they more than doubled their guidance, right? Absolutely incredible stuff from this company. Looks like they have massive amounts of traction for their products. Over here, they kind of show some of their brands and all that type of stuff. Global market highlights. Crocs brand continues to resonate globally, with international growing 24%. Australia and China grew triple digits. That's absolutely ridiculous, but it could be that those countries, they had very low comparable estimates from the previous years. So I'm not here to try to pick that apart, but yeah, that could be the reasoning for that. Skipping a little bit further into a couple slides down, brand here they talk about capital allocation priorities. Brand growth investment. 2024 is an investment year supported by our best-in-class gross margins, right? Absolutely, we just covered it, right? They have like Google-like gross margins. They also talk about debt pay down, right? So they leveraged up the balance sheet to buy the Hey Dude brand a couple years ago. And over here, they talk about how they're really trying to pay down that debt. Total borrowings of $1.7 billion within our target range of 1 to 1.5x. I believe this is debt to EBITDA. I don't know what this is speaking to. Return on capital to shareholders, roughly $900 million remaining on the current share repurchase authorization. This is a company with roughly a $9 billion market cap. That's 10% of the float. So they're doing 10% buybacks while also paying down the debt. That's absolutely incredible, right? And this is a company growing revenues at 16%. So you take 16% and you add up 10% on top of that. That's, if the margins stay flat, that's 26% per share growth, both on EPS and free cash flow. 100% free cash flow conversion, of course. That's a lot of financial jargon, but what you have to take out of that is that's like 26% EPS growth, 26% free cash flow growth, right? Just purely based off the buybacks. Our plan is to buy back shares and repay debt during 2024. Absolutely incredible. Absolutely incredible. Guidance Q2 and full year. Over here, they talk about a little bit of CapEx. A little bit of CapEx never hurt no one. Revenue growth. They talk about revenue growth on the Crocs brand. It's going to be roughly in the 7 to 9% range, right? So it seems that was maybe a one-off quarter that they grew 16% and they exceeded expectations. But again, even with like 7 to 9% growth, and then you chuck on the 10% buyback, but that is assuming that the multiple doesn't expand, right? Total revenue growth 1 to 3%, that's not as impressive, right? You have massive declines on the Hey Dude side of things that are just destroying total revenue growth. So that's the one part of the business that I'm a little bit worried about, is this Hey Dude brand seems not to be doing too well. And then they say operating margins is going to decline a little bit. This would probably have to do with the massive decline in Hey Dude revenue growth. I'm sorry, it keeps flickering, by the way. I don't know what's going on with the face cam here, but anyways, yeah, it seems they just do some reconciliations and all that type of stuff. Moving on, I want to dive into the risks of the business, right? So when you have a business that is solely relying on the fact that people are coming back to this business to continue buying their products purely based off the brand, it always carries a little bit of risk with the fact that that brand could go out of style. And the example I'd like to point to is VFC. I'm not sure quite exactly what it stands for, but as you can see, they own a bunch of recognizable brands, notably, of course, Vans, North Face, Timberland, Dickies, JanSport, the backpack company, Supreme, the almost boom and bust luxury, I guess, hype company, whatever. But anyways, this company, of course, over the past decade has done incredibly well, right? Like brands-wise, these are very recognizable brands. But if you were to look at, again, we're going to go back onto FinChat here. If you were to look at the stock chart, I think it very much tells a story of this brand got incredibly popular in the 2015 range. This is with the hype of Supreme and all that type of stuff. They're doing blowout sales. There's lines of people going out the Supreme store, all that type of stuff. And you could see that in the 2018 to 2020 range, stock price peaked. And if you were to scroll down here, the chart doesn't go that far back, but I would assume that that's when they were actually still growing, right? VFC, the corporation, it was still growing because of the hype off of the Supreme brand, the JanSport brand, all the other Timberlands and all that type of stuff, right? And since then, you can see since 2019, the revenues have gone absolutely nowhere. 10.2 billion in 2019 and 10.8 billion in the last 12 months. It basically hasn't grown, right? If we do revenue CAGR here, it's grown at a compound annual growth rate of a negative 1% since back here, right? So as you can see, with these companies where they solely rely on brand, it might reach a tipping point where all the people that want to buy that brand it's like a very saturated market, and perhaps actually other companies start to dive into this category. And again, I think the IP with actually owning the plastic, this kind of defends it against something like this, where the brand just goes out of fashion, just because you can't get the Crocs shoe other than Crocs itself, just because they literally own that plastic. But anyways, this is something to consider with this type of company, right? If it solely relies on the brand, what if the brand goes out of fashion? What if people start to buy other things? What if other comfortable shoes start to become the category leader, right? And especially with revenues not growing that much back here on the investor presentation, again, the Crocs itself is growing well. Total company revenues isn't growing that well. So when is there the day where Crocs itself, the revenue slows down, right? And you can't really predict these type of things, right? Like you can't really get a sense of social sentiment around the company, right? So again, just some risks that a company like, I don't know, MasterCard or Visa, which are of course some of the best businesses in the world, like you have a much easier time sleeping at night. Like there's a lot more babysitting with a holding like this than something like MasterCard, Visa just chugs along, grows revenues 10% every single quarter. You don't ever have to check back on it, right? So again, something to consider with investing in a company like this. I'm not discouraging anyone. The valuation's absolutely dirt cheap, right? But anyway, something to consider. Moving on, just another thing on VFC. Over here, I pulled up the price to free cash flow chart, and you can see that it was demanding it's kind of skewed just because the past year they went super into the negative, but you could see that like it demanded a very, very high multiple. So that's another thing that to take into consideration, right? So something like VFC compared to Crocs, they had a significantly higher multiple, which of course kind of contributed to the downfall over here. I think they're down like roughly, let's check this on drawdowns here. They're down like 80%. Oh my God, 88%. Absolutely ridiculous. Moving on, I actually put out a tweet talking about the absolutely dirt cheap valuation that Crocs trades at. And the starting line over here, I said, free cash flow, if you believe that free cash flow is going to grow by at least 7%. Might I remind you, revenue is growing at 7%, and they have a history of growing margins, right? So if you believe that, the free cash flow growth comes in at the bottom of their estimates, and it's just one-to-one with revenue and free cash flow, then the company's trading at just a disgustingly cheap valuation, right? I have it at roughly 1.6 times the free cash flow to growth multiple over here, and you're buying a company that's growing free cash flows at 7%, at 11 times price to free cash flow. And that's just normal free cash flow. We're not talking about per share. So as you just saw a couple slides ago, they're doing about 10% buybacks. They're buying back 10% of the float every single year, and they have that authorized, like good to go. So just something to consider, right? Like the per share, you could literally just add that 10% onto the 7% free cash flow growth. You're getting 17% free cash flow per share growth for 11 times. You know what? Let's go over here to my spreadsheet here. Yeah, so over here we got Crocs, and again, you see it's 11 times price to free cash flow with 7% growth. What happens if we bump this up to 17, right? 17 because of the buybacks. That's absolutely disgusting. 0.65 times the free cash. This is the lowest I've seen with any business ever, right? Again, it is per share, and we are of course assuming that the stock price stays at this low of a multiple and that they're able to consistently generate revenues of roughly 6-7%. So a couple ifs baked into the price here, but you're not jumping through hula hoops to try to get this done, right? Like 6% revenue growth for a company with this type of brand, it's not that lofty of assumptions. And on top of that, like if the multiple stays low, you're looking at massive buybacks for years to come, perhaps, right? So over here, as you can see, it's quite literally the cheapest in any of the stocks I have over here on the list. With that being said, what am I going to be personally doing with a company like this? I tend to stay away. And even in the tweet I had over here, I said, let's take a look here. Not my style of investing per se, but something to look at perhaps. So I don't know. I'm not one to try to dive into a company like this. I feel like there's way too much babysitting and stress of like, I don't know, what if the stock shot down? What if they have a bad quarter and it shoots down like, I don't know, 30, 40%, right? I don't think I'd be willing to hold through something like that. I don't believe in the company that much. But things like the intellectual property with the plastic, that massively plays into me being willing to at least perhaps allocate a smaller percentage of my portfolio. But at that point, like I start to battle with myself of like, why would I even allocate that small of a percentage to a company like this, right? Might as well just put it into higher conviction bets. I'm not saying you can't make money on it. I think the stock price really is evident of something like that, but I don't know. I'm just a little bit hesitant with companies that are like super reliant on their brands. Doesn't matter if they've been around something like Nike, like 30, 40 years. I don't know. I just have a hard time grasping that brand being diminished or all that type of stuff, right? I don't blame anyone jumping into a company like this. The valuation is just disgustingly cheap, but just not my cup of tea. Moving on, I decided to start chucking these at the end of the videos from now on, just some comments on my personal portfolio, what I'm thinking, all that type of stuff. Of course, on May 9th, I did in fact sell out of Starbucks, and I put it right away all into SCHG, and I'm happy holding that. Starbucks was, I talked about this in the last video as well, but Starbucks was just, I was souring on it with how bad the revision was. Again, this kind of just speaks to what I just said about Crocs, right? Like I'm not really willing, my tolerance for holding a company through trouble is exceedingly low. I'm not willing to hold a company when they're executing incorrectly and all that type of stuff. It's so much easier to just buy Amazon, and a little bit hypocritical, but just buy Amazon, and every single quarter you just see the AWS revenue line just go higher and higher. Thesis is on track. You don't have to worry about anything. Salesforce even, right? Every single quarter, the total performance obligations keeps climbing higher. MSCI, right? Of course, they had the recent quarter with 2% down on retention rates, but I think it was justified. I did a whole video on that, right? I'll put it in the show notes, whatever. But I don't know. It's just so much easier to buy these subscription companies compared to something like Starbucks, where, like, of course, there is an element of subscriptionness to it. Every people just coming in and buying every single day, every single week. But like having an actual subscription like Salesforce, like Amazon, like even Google, right? MSCI, all these companies, they have genuine subscriptions. I feel like that's such an easier hold. You just look at the financial performance of the company, and it's just so easy to like have the fundamentals back the stock, right? Like even if it drops 10-15% in a day, I had no problem with MSCI dropping 15% in a day. I was just looking at it like the market's incorrect, and then stock bounced back right away, right? Of course, I'm not some crazy wizard that picks these items out, but I'm just saying when it's a subscription model and the fundamentals back the stock performance, it's so much easier to hold that company. So just personally for my own gut, I decided to sell Starbucks, and I just keep it in SCHG for now while I maybe figure out some other deals, and perhaps like whenever I don't know where to put cash, I just chuck it into the ETF, and then I don't care if I bought it incorrectly, bought it too high, whatever. I'll figure out where to put the cash eventually, or just keep it in SCHG. No problem doing that. It's the best growth ETF. Fun story, I actually went down the list of every single growth ETF, and I did like the top 15 by what's it called, volume or assets under management. I went down the list, right, and I looked at every single one. In my opinion, SCHG has like the best balance of everything, right? Anyways, enough about that. If you want to see my live portfolio, if you're watching this in the future, just go to my Twitter. It's pinned it's pinned at the top of the page, so you could go ahead, check it out. Maybe I've changed some things, whatever. And of course, I talk a lot more on Twitter about my thoughts and all that type of stuff. I post a lot on there recently. So yeah, just go ahead, check out the Twitter, pinned at the top of the page. At last, if you want to leave me comments, I read every single one of them and respond to every single one of them. So go ahead, leave me comments, thoughts, concerns about anything really. The Starbucks sale, Crocs. I'm actually interested to know what you guys think about Crocs. That is what the video is about. So but I'm genuinely curious, like what you think about a company like Crocs. Of course, it's not the traditional style of investing for most people, but yeah, just go ahead, leave your thoughts down below. I'll be reading every single one of them. And at last, I want to ask you to do something that costs you nothing, but would help me out greatly. If you could hit the subscribe button, you could always go back on that decision. You don't have to stay subscribed forever, but I'm going to continue to post high quality videos just like this one. With that being said, thank you for watching. Have a great day.